Just wanted to ask each of you to sum up your own or perhaps your firm's risk management philosophy as it applies across the board, from operational to investment, all the different types of risks that we've been talking about. Tim?
I guess from its founding, Caxton has drawn on and helped to develop the sort of CTA-ish kind of trading philosophy in the futures markets, where you could be long as well as short fairly easily, but specifically where if your trading goes against you, then you respond fairly quickly to that signal. So the idea that even a great trader is going to be wrong half the time. Hopefully the times they're right, they make more than the times they lose. And so that's the reduction of exposure upon losses, which is effectively dynamically replicating a long option position. That's very much a part of where Caxton has come from. And well, the firm has diversified across other strategies besides futures, and now does a lot of a range of things in liquid markets. That remains a core principle of risk management. So I think if you're going to do that, if you're going to sell because you've had a day or two or three of losses, in order to have a successful operation, you need to be in liquid markets, because if you're selling liquid stuff after a couple of days, you're going to get killed on the bid offer, and you're not going to be viable. So the sort of corollary then is, well, be in very liquid markets, be in the most liquid markets. And I think those really form from the beginning and then through now, have formed the core of what we've tried to do.
Thanks, Mike.
So I think the importance that we place on risk has to do with performance, which I realize is somewhat of a paradox, in the sense that we don't think you really can outperform building a hedge fund portfolio, the industry, by picking one manager over another, where the manager you pick outperforms market by 20 or 30 basis points. How you outperform the market is by avoiding disasters. So not investing in the funds that are blowups and have liquidity issues and so forth. So it's really through risk that I think you can do a better job on the top line, instead of just viewing risk as this sort of abstract thing that ex-physics guys do. Sort of to do that, I think our approach has been to specialize on the due diligence side, so have a separate group for the front office, separate group for the back office, separate group to do meta risk analysis. And what I mean by that is the risk group at JP Morgan is doing an analysis on the risk group at Caxton or whoever. So how good is that risk program? Do they have the right controls in place and so forth? So through that specialization process, I think we do a really good job at figuring out where the holes in the process are. And one final thought that I'll leave you with is the number one thing that I think we're looking for across the board is a balance of power. Meaning, if you have really smart guys on the front office side, and the guys you meet in the back office side or the risk side don't seem nearly as smart and savvy and have been in the industry very long, that's not a fund you want to invest in. You want operationally and risk-wise the fund to have a balance of power, and that's sort of a recipe for a successful program.
Michelle?
Well, that sounds like utopia for most of my friends who are risk managers, because they say that they're always ignored. My firm is somewhat smaller, less complicated business model. The way we address risk on the investment side is we slice and dice our portfolios every which way to make sure that we understand the bets that are in the portfolio. Now, the only way we can outperform our benchmarks is by taking risk, and we have no problem with it. I just want to make sure that what the portfolio says that we're taking matches what we think we're doing. On the operational side, balance of power, checks and balances. So I think it's very important to make sure that you always have the appropriate levels. you don't want the, referring to old history, Nick Leeson problem where you have the trader clearing the trade, so you've got to make sure that, from the time the PM puts in an order, it looks right in the system and it meets guidelines. Then after it's gone through the trading desk, we make sure that our compliance manager checks if any triggers were tripped to make sure that things were not done inadvertently. And then over and above that, every month our compliance manager does a manual check to make sure that he didn't miss anything. Things always need a couple of signatures, and hopefully that way we'll avoid either mistakes or problems.
Thanks, Brian.
Well, I think it's pretty well covered here, and I guess the only thing that I would add to this, and actually people have already really talked to it, I think it's the amount of thinking and the amount of resources and the amount of systems development that's happened in risk management is encouraging. And I think those are fundamental requirements. You've got to have good experienced people, and you've got to have good systems, and you've got to have independence for checks and balances. What I'd add to that is to make sure that we don't lose in that an over-reliance on those systems and professionals and checks and balances. Because I think the lesson from a lot of these recent problems is can often be traced not to necessarily the complexity of the strategies, and not necessarily to the lack of systems or the ability to analyze, but maybe the lack of executive engagement, really understanding the bets, both from an investment side and from a non-investment side, and an over-reliance on systems and analytics as opposed to just doing your homework. So again, when we go, in the past few years, going to visit managers and walking into a room to talk about, for example, a soft dollar committee, and meeting the CIO of a firm that we really like, who didn't realize he was the chair of the soft dollar committee, that's not going to fly anymore. Another very well-known and very well-respected manager, we went in to meet the operations team. Their compliance officer, who had been in that position for 3 years, walked in and introduced herself. And the operations team all got up and introduced them. They weren't quite sure if she was with us or with them. Those sorts of things aren't really going to fly anymore. And in general, I think whether you look at investment risk, operations, regulatory, and some of these other elements, liquidity and counterparty risk, you've really got to understand the bets that you're making. I think it's one of my favorite Yogi Berra isms is predictions are hard, especially about the future. There is no proven way, or at least I haven't found it yet, to tell which investments are going to play out and which aren't. The best thing you can do is understand all of the features of the bets that you're making in your program, and make executive level decisions about whether you're okay with those.
All right. I'd like to thank our panelists for that and open the floor to questions for the panelists. We have a few.
Richard Wright, RBW Capital. Brian and the panel, with regards to managing balance sheet risk for government balance sheets on leverage, what would you say about, you worked in Japan specifically, with the 180% debt to GDP ratio. Could you comment on that? Thanks.
Let's start with Michael. You want to give that one a shot first?
There's a state of the world that I think that we spend a lot of time thinking about, where everything or correlations go to one again, and that state of the world I think is driven by sovereign risk at this point. So it is the number one potential culprit for double dip or worst case stress scenarios. So as we're looking at debt to GDP ratios globally, there are a number of countries, including our own, where there's a serious risk of a tail event especially if China decides they want to buy something else aside from U.S. government securities. So that type of scenario is something you want to make sure that your portfolio is, at least your hedge fund portfolio, if not your entire portfolio, has some hedge in place against. So it helps to have a number of bears as well as bulls in your holdings.
Yeah, much better than I could have done. I think the other thing that we look at, and maybe potential hedge, is some sort of currency management. Because as Michael said, and I think it reflects our view too, that sovereign risk is all over the world. It is hard to figure out who's going to be next and what to do about it. But I think we're seeing more of our clients, and certainly more of our internal portfolio managers, looking at the currency markets as a way to actively hedge against some of those risks.
One other comment on that is that that's a good example, I think, of an area where there's some real beneficial trends if one responds appropriately. And the beneficial trends are a lot more volatility in yields, in many sovereign yields. And that's great as long as you cut the size of your notional position so that you haven't, without realizing you haven't tripled your risk. And if there is a jump to default or a change in volatility, you're not caught out.
Thanks.
I wonder if we could talk about the big versus small debate. We are at a newer fund that, because of a very institutional partner, has a very well-developed, I think, and certainly hope, risk management process, certainly much more so than a much larger fund that I was serving at previously. And I wonder if perception among institutional investors is that larger funds, because of arguably greater resources, do have better risk management profile.
I think historically that has been the perception, but I think it's changing a little bit. One of the things that we've learned, part of our program is we spend a lot of time looking at regulatory filings and disclosures and things like that before we go to visit a manager. There was some interesting research that Yale did a few years ago when the first attempt to make hedge funds register was floated. And they looked to see whether there was any correlation between the disclosures in the Form ADV filing that all U.S. advisors have to do and future operational risk. It was interesting. They found 3 areas where there was a significant correlation. One was in regulatory disclosures, so the bad boy provisions. Another was in conflicts of interest. And the third was in concentration of ownership. And they found that firms that where the ownership was concentrated and the management team had a large stake in the outcome performed significantly better operationally and from a regulatory perspective than some of their larger counterparts. So I don't think it's all one way anymore. I think it really has a lot more to do with getting to know the people that you're hiring and how seriously they take this and how well developed their programs are. Much less assumption that size equals security.
I'd add one part of the diligence process that probably is in the favor of large funds is large funds tend to communicate what they're doing better and more efficiently in that they've been doing it for a while. So they have a very well-developed DDQ. They know what questions probably that we're going to ask when we come in the door versus sort of a discovery process with the new fund. So you may have the exact same risk programs and operational controls. It just takes a much longer time to diligence one versus the other.
Thank you. That will conclude our session. I'd like to thank everyone on the panel for some really great insights.